perspectives here. All right, so what it says now is, on January 1st, your employer pays this tax on your wages. When you earn $7,000 in that year, your employer quits paying it. Okay? All right? Yeah,
What
Jean?
does it say under state unemployment tax? The 5.4 of, what does that say?
Oh, of the first 7,000.
Okay.
5.4 of 7,000. So this has a cap of 7,000. Okay? Tiffany, we'll see you Wednesday.
Okay.
All right.
Thanks for
And then-
announcing my,
Sure, and what?
thanks for announcing my departure.
Oh, it was meant kindly. Did that embarrass you?
No, it's okay.
All right.
I'm loud anyways. Bye.
All right, well, listen, we'll see you Wednesday.
Okay, I'll see you
Okay.
Wednesday.
All right. It was meant kindly. It should be quiet time. All right, okay. All right, so 7,000 times 5.4%, that equals $108. So the employer also pays $108, and the employer only pays SUDA. It doesn't show up on the employee's side at all. Yeah,
You were calculating the SUDA for the whole amount, but the employees is only 2,000? Is that how it should be done?
no, well, this was all 7, right?
Mm-hmm.
No, what it boils down to is now, this is a tax that only the employer pays. And, oh,
But we're looking at the
you are
same,
absolutely
we're
right.
looking at
Thank
the
you
same
so
one
much.
month, and it was 2,000.
And it's on the 2,000.
Okay.
Thank you, thank you. Yep. All right,
Is that still 108?
yeah, still
Yeah.
108, because I'm just copying it down.
Is it, it's 5.1% of the first 2,000?
It's over
No,
7,000.
it's a cap of, it's on the full,
It's
it's
up
on the
to-
gross.
Okay.
And the gross is 2,000,
Okay.
but it has a cap of 7.
So if they,
So when you were, so your employer, now, imagine you have a job, okay?
I do.
Oh, good deal, all right, but I've got to ask this, if you have a job, on the job, your employer pays this till you earn 7,000 and your employer quits paying.
Okay.
And it's figured off your gross with a cap of 7, okay?
So if
Now,
you're,
FUTA stands for Federal Unemployment Tax Act. By the way, it's going to be interesting, you know, on these tapes, it'll be interesting to see what I look like. You know, what does all this joking look like? Maybe I should try and act more professorial. Maybe that's what I need to do. Now, you guys, I'm going to get up here and I'm going to pontificate. No, seriously, don't you think that would work better?
No.
And what I'll do is I'll speak from my belly so I have a resonant tone. All right. Now you guys, listen up. And from now on, no stupid questions. Think them through. If they don't sound good, keep your mouth shut. All right, ready? That would work, don't you think? Oh, and we'll throw them in. Oh, how's it go? Oh. That's right, isn't it? Well, I was in the Air Force, but this is before we had these, we just didn't have AL in those days. I think that it came in after I was in the Air Force. Yeah, oh. That's that right. Anybody here a veteran during that era? Hoorah! It was before after my time. Well, you guys, here it is. Federal Unemployment Tax Act, okay? And in this case, again, the cap is 7,000, but now it's 0.8%. So that's okay, so it's 0.8%, which is 0.008, okay? So that turns out to be $16. And it is from the 2009, thank you. All right, so FUTA is 16. Now you add all these up, and that comes to 277. So now, your employer has the total cost of the employee to this employer is 2,000 gross pay, plus 277 payroll taxes, That means 2,277 is the total cost of this employee, or these employees. Okay? And it's, so here's the gross pay. Okay, here's the gross pay, this 2,000. All of this is withheld from the employee's check. They're all payable because they're sent to somebody. In addition to this gross pay, the employer pays these payroll taxes. There's these four. The employer matches the FICA, and I'll be right with you, matches the FICA as SUDA and FUTA. Yeah. Now, by the way, SUDA, and I'll be right with you, SUDA and FUTA, when a person draws unemployment compensation, these taxes fund the unemployment compensation. That's where it goes. Okay? Yeah. All right?
So for this journal entry, you just did the tax expense. So when you
Yeah.
record the wages, you do that in a separate journal entry?
Yeah.
Yes.
One journal entry, two journal entries. First, second, and they're just totally different. Okay? And again, this is the gross pay, all this withheld. Now, what happens in here is FICA Social Security payable is the same account as FICA Social Security payable. Both of these will go to the same account. But this is the amount that the employee pays, this is the amount the employer pays. The same with FICA Medicare. Same account, name, same account. This, okay, and they're matching. Now, FUTA and SUTA are only the employer, okay? All right. And then this is how much goes into the paycheck. Yeah, Michael.
And then on the federal employee, the FUTA tax itself, it's always gonna be 0.00, well, given in this demonstration, 0.008 of the actual payroll amount.
Of the gross.
pay. And cap is 7,000 no matter.
Yeah, yeah. Now, by the way, when you read the textbook, this can be a little confusing. Here's the way this really works is, FUTA, and so FUTA is 6.2%, okay? And what they basically say is, well, I'll be with you in a sec. So what the deal is, this is the federal government, it's 6.2%. So the federal government says to the states, if you want, we will send you the bulk of this and you administer the program. So that if you or I draw unemployment compensation, we go to the state of Washington for that. So now, SUTA is 5.4%, the difference of 0.8%, and don't forget 0.8% is 0.008. So if a state, which most do, choose to administer the program, they get the 5.4%. The difference is then sent to the state, okay? And so this is reduced from 6.2 to 0.8. Does that make sense? Yeah.
So if you happen to live in a state that didn't choose that option, you would only have the FUTA entry?
Exactly. And then things like Nevada chooses not to have anything to do with Social Security, so they don't take out any of it. So you retire, there's no Social Security, whatever that is. Yeah. Yeah. So they choose not to have anything to do with it. Yeah.
So say you lived in a state that takes Social Security and you decide to move to Arizona where they don't, do you still get your Social Security?
I'm sure you do. And the reason I say that is because you can move overseas and draw Social Security. Because you can read a lot of, if you move to a lot, like you move to Central America, they have stable governments and the cost of living is very low. And so you can live like a king on your Social Security. So it goes with the person. Now, and the other caveat I have to say on that is all these things are so complex. You got to just see what the tax law itself says. As a general rule, because it works that way overseas, I'm sure that if you and I retire, if you work in Washington State and you retire in Arizona, I might get, it's hard to be in your Social Security. But it's so picky. You got to.
You just paid into it, right?
Provided you paid into it.
And if we had a job.
Yeah, and you got to imagine. So you imagine you have a job, yeah.
So
I don't like that scenario.
Okay.
for the top FUTA,
Mhm.
did you need FICA or
No.
do you need FUTA?
I mean, no, okay, all, both of these, here we go.
Dark out.
Yeah, these two are those. Okay, so, and by the way, it's not clear when you read the book, it's really kind of fuzzy, but all they're saying is the fact that FUTA is the Federal Unemployment Tax Act. And FUTA, part of this act says, if the state chooses to administer the unemployment compensation program, they can take the bulk, which is 5.4%, and then they'll administer it, and your employers will send it directly to you. We still want 0.8% to administer our part of it. And Junior, we started talking about what is a liability. So what is a liability? Well, the deal is it's a present obligation that resulted from a past transaction that we're going to pay in the future. Okay, so that's what an obligation is. So it's a present obligation that resulted from a past transaction that we're going to pay in the future. Okay? A current liability. What's a current liability?
Paid in one
Paid
year.
in a year
or
or a recycle cycle, whichever is
Greater.
longer. Good. Greater, longer. What's a long-term liability?
Anything greater than your operating cycle.
Whichever is longer.
Whichever is longer.
Okay? All right. So, what are some examples of known liabilities?
Accounts payable, sales tax, and earned revenue.
Sure. All right. Let's take the sales tax. How do you figure sales tax? So, what you do on this thing is the sales equals the actual sale, right? Sales tax is above that. You add the two together, that's how much your customer pays you. Because the sales tax is a retail tax. It's what a store charges its customers. Okay? All right. Unearned revenue. What kind of account is unearned revenue? Liability. What causes an unearned revenue account of this liability?
Prepayment.
Some sort of a prepayment. Okay? When you receive the money, what do you debit and credit?
Cash and unearned tax.
Cash and unearned revenue, sure. When you earn the money, what do you debit and credit?
Unearned revenue.
Debit unearned revenue and credit revenue. Does that sound good? Okay. Now, what's a promissory note?
Unconditional promise to pay.
Unconditional promise to pay, exactly. So, when you convert, and how do you figure interest?
Interest on interest.
Interest equals principal times rate times time. The time will always be expressed in what, how many days to a year?
360.
360, okay? So, in this case, what you did is you converted, so you called up your supplier and said, I'm short of money, I'm going to pay you. And he says, fine, let's make it a note. So what you do is, you send him $100, it's a $600 accounts payable, you send him $100, that makes a $500 note. So this is what it's like when you convert the note to an accounts payable, okay? Now the note has interest, so when you pay it, you debit the notes payable, debit the interest expense, credit cash for the money you sent. Does that sound good? All right. Over here, now what we did was we borrowed the money. Now, this is where we converted an accounts payable to a notes payable. You can also use a note to secure a loan. So when you do that, because then you debit cash and credit notes payable, at the end of the accounting period, you do an adjustment for what? For the interest that's accrued in that accounting period. Does that sound good? Okay. So what you do is you start out with the date of the note, and is there any interest in the date of the note?
No.
No. So in this case, it was December 16th, 31 days in December. That means there's 15 days of interest. Principal times rate times time, so it'll be a debit to interest expense and a credit to interest payable for the interest. Okay. All right. In this case, you just paid it back. Okay. All right. Here's the adjustment for the time in the first year. Then when you pay it in the second year, you debit the interest expense for the interest that was accrued in the second year. Now I'm kind of jumping around. You guys yell if I'm not clear, all right? Then you have the interest payable from the previous year, add those together, plus the note payable is how much money you pay. Does that sound right? Kind of jump around, everybody kind of jogging their memory? All right. Now, then we got into wages. So, gross pay is what? It's how much the employees earn. Then you subtract out federal income tax. Now, what is this federal income tax? Well, it's the amount of money that your employees will pay on the wages they earn. Okay? Where do you find the tables? Circular Employer's Tax Guide. State income tax is also taken out if we're down in Oregon. Now, FICA, what does that stand for, Michael?
Federal insurance contribution tax.
Federal Insurance Contributions Act, okay. It has how many parts? Two. The first one is Social Security, and the Social Security usually has a cap. Okay, in this case, it's 6.2% on the first 106,800 anybody earns in a year. That means that the max they'll pay is 6,621.60 because that's 6.2% of the cap. Okay? And we call that what kind of a tax? Regressive. Regressive. A progressive tax is when the rich pay a higher portion.
I said regressive.
Oh, you said regressive, okay. Okay, good. Medicare, in this case, it's 1.4%, 1.45%, there's no cap, okay? Voluntary deductions like United Way, retirement, and like Clark, I put 10% of my wages into PIA crap, medical insurance. Then net pay, what are we talking about net pay? It's take home. It's what you take home, okay? So gross pay minus all these withholdings gives you your net pay. So in this case, the journal entry looks like this. You debit salary expense. What is salary expense? Is the gross. Then all of these things are withheld. They're all payables, right? And salaries payable is what? That's take home, okay? In addition to that, the employer pays employer payroll taxes. Social Security, how do you calculate that? You just copy it. They match it. If whatever you figure for the employer, it'll be a match. How do you figure Medicare? It'll be a match. FUTA, you take the gross and you multiply it times 5.4% for SUTA. What's the cap? 7,000. FUTA, which stands for Federal Unemployment Tax Act, it's the gross times how much? 0.0, what is it? Which is exactly, and only the employer pays SUTA and FUTA. Okay? How's everybody doing? Yeah.
The 1.45%, that's the no cap for FICA Medicare, that's the given across the board.
It has to be, all of these things have, all these tax numbers have to be a given, because they don't,
And there's never a cap on that, at least the legislative.
not never, there never has been. Okay? And again, when you're on the job, use whatever tax rates are in effect at that time, whatever tax rates and caps are in effect at that time. These are the tax rates and caps that were in effect when the textbook was written. Okay? And they will be different on the job. It's like 4 or 5 years. Okay, so good?
Yes.
All right. So